Good afternoon, and thank you all for taking the time today to join us on our second webinar of the series Global Equities in a Year of Change. My name is Joe Lichtauer, and I'm delighted today to be joined by Ian Pyle, one of the portfolio managers on Shires Income. Shires is an investment trust situated in the UK income sector, and it aims to provide investors with that resiliency of income alongside some long-term capital growth as well. And before I hand over to Ian, I'll quickly just cover off some of the format for today's webinar. We'll be going over the presentation on the trust, and then we'll be following that by 10, 15, 20 minutes or so of Q&A. So if you do have any burning questions you'd like me to put to Ian, please do pop them in the Q&A box on the bottom right hand of your screen, and we'll do our absolute best to get to them at the end of the presentation. So with that, it's an absolute pleasure, Ian, to welcome you. Please take it away.
Great. Thanks very much, Joe. Thanks for hosting me this afternoon, and thank you everyone for dialing in and listening. So the remit for this presentation was global equities in a year of change, and I thought I would give a quick intro to the trust first, for those who are not familiar with it, and then talk about change this year in kind of three lenses. So political change, economic change, and market change. And as we kind of step through them, we'll get closer to the actual investment decision and what we're doing in the trust at the moment. And then I'll finish up talking about that at the end. But firstly, let's start off with the trust itself. Shires, for those not familiar with it, is a real income strategy. What we're trying to deliver is a resilient, high level of income over the long term and still maintain the potential for capital. The way we do that is by investing primarily in UK equities, but we are somewhat differentiated through the main differentiating factor is that we also have about 20% portfolio in high yielding preference shares instruments. Then we also hold some overseas equities for more diversification. And we're a bit different to a lot of UK equity income vehicles because we have a genuine multi-cap and size agnostic approach. So a lot of small and mid cap in there as well. And if we were to use one chart to kind of demonstrate the approach of Shires, then it would be the one at the bottom here, where we just break down the portfolio into the different yield buckets with low yielding positions on the left-hand side going through to high yielders on the right. And what it shows is that we have this big block of preference shares sitting over on the right hand side, giving us a really nice high yield, most of them over 6% at the moment. And that allows the equity portfolio, which are most of the bars on there, to be much more diversified. And we can have a nice range of things which are not just high yielders, they're also things which have either genuine growth in them or they have good dividend growth within them. When we are thinking about the outcomes, the main outcome from the trust is the yield. It's that the historic yield at the moment of just over 6% is obviously significant to benchmark, and it's also a premium to what you even before we start to see interest rates fall. We pay quarterly dividends, and over recent years we've got a pretty good track record of edging that dividend up over time. Also, what we found is that the income generation from this resilient, something that was really tested through the pandemic period when benchmark income generation fell a long way. Shires was much more resilient because the preference shares offer consistent yield, and obviously as active managers we're able to rotate and move to other sectors and move overseas to make sure that income keeps going and hopefully over time keeps growing as well. Thinking about dividend growth, one thing that I would call out as characteristic of the companies we invest in is that we are really looking for dividend growth, so not just high yield. And the chart on the bottom there just kind of shows you where we sit with dividend yield of the positions on the y-axis, dividend growth on the x-axis. You can see the FTSE All Share where it sits, about 4% dividend yield, about 2% expected consensus dividend growth over the next 2 years. The Shires portfolio is obviously going to be higher yield, but I think one thing that a lot of high yield investments don't capture is dividend growth. And Shires portfolio has a really differentiated amount of dividend growth, up over 10% expected over the next couple of years. So that gives us real confidence that as well as delivering high yield now, we can also look forward to some income growth over time. Okay, so moving into the main bit of the presentation, we're going to start with political change, and it's something probably fund managers like me are not massively qualified to talk about, but it's hugely important and it's hugely interesting. And when we arranged to do this webinar, we actually did it before the UK election board. We all thought it was going to be a November election, and we all thought we were going to talk today about the lead into the UK election, what was going to happen. Obviously, in the event, we had an early election. It was a surprise in terms of timing, but obviously it wasn't a surprise in terms of outcome, with a Labour majority and a strong Labour majority. When we look back at it, I think the outcome is clear. I think one thing that does stand out when you look at the actual data is that despite Labour having a very strong majority, the actual share of the popular vote was very low. So when you break down what happened in the voting patterns, then the chart on the right shows you that there actually Labour didn't win much more votes. It was much more that loss that the Conservatives faced with their vote going to Reform and other parties, and that resulting in the change of government, with the UK electoral system obviously massively favouring Labour in this election. And it's interesting. It leaves us with one very good outcome, which is a very stable political environment with a majority of one party which can get things done for the next 5 years, which is actually a great setup compared to most of the rest of the world. It also means that we've got a government who probably actually have to work pretty hard to keep everyone happy at the moment. And you've probably seen that already, in that the honeymoon period has been quite short, and suddenly Labour has to work hard to keep both the traditional left happy, but also the more centrist vote that I think they attracted this time round happy as well. And that's probably not a bad outcome for UK economics and potentially for UK markets as well. If we think about where UK politics sits at the moment, the confidence indicators, so PMI for industrials and CPI as a consumer confidence measure, are a good way to think about things. And what we saw post-election was actually a nice bounce in UK confidence generally, because the election was done, there was certainty, people felt a bit better. It probably coincided with a time where inflation was coming down and people felt a little bit more wealthy. But as the honeymoon period has ended, we've started to see that confidence decline slightly. And I think that partly reflects the fact that the Labour government is trying to get the bad news out early before the budget. It's trying to put the difficult financial situation, as they would characterise it, on the shoulders of the preceding government. And hopefully we now get a bit more good news and get a bit more confidence back into UK politics going forwards. From an investment point of view, it's always hard to gauge how investors think about the UK, but the chart at the bottom there shows you the Bank of America Fund Manager Survey, which is an always interesting, if imperfect, measure. And what you can see there is the kind of blue bars, the light blue bars, are percentage overweight and underweight of international managers in UK assets. And as of the last survey, we got back to the first point since 2021 when asset managers actually overweight the UK index. And that doesn't happen very often, at least not for a long time. We'll see if that holds and becomes more persistent than it has in the past. But it's an interesting signal, I think, that having certainty for UK politics is actually very helpful for the UK market and for UK investment after a period where we've had quite volatile governance and volatile policy. And a reminder of that is if you look back at the consumer indicators, you see a real low in September 2022, which was the kind of Trustonomics incident where the UK looked very poor. The next big political event, and the one that is still to come, is the US election. And I would kind of say it's very opposite from the UK in terms of the way we think about it and the potential impact on portfolios for us as investors. The main difference is with the UK, we had a very clear view of what was going to happen. I think a Labour government was widely predicted and very easy to bet on. This time around, the US election really is a coin toss, genuinely. Also, making investment decisions becomes somewhat more difficult. And if you look at the odds, or if you look at the polling for the US election, an interesting table is actually the one on the top right, which is the one we look at. if you look at the share of vote for Harris for the Democrats, Trump for the Republicans, then it is extremely close. And it's not only extremely close at the national level, but if you go down into the 6 swing states which will decide the outcome, it is extremely close in all of those states. And it's close enough that if you look at the change from last month on the right-hand column of that chart, that kind of covers the difference between the vote share as it stands at the moment. So month on month, you could see those swing states switching from one side to another. At the moment, it looks slightly like Harris has an edge, but this is one that is genuinely too close to call. So we try and think about what are the potential outcomes for investment, and the table down on the bottom left there kind of gives you our economists' scenario analysis on this one. Policy continuity, the most likely, is effectively, say, Harris wins. She continues with the policies that the Biden administration has had over the last 4 years. And that's probably the easiest one to call. We don't need to think too hard about what that will mean for the economy. It probably favors more energy transition, more investment, stability, a high level of capital investment into the US, but it won't change the balance of trade or anything material externally. The next scenarios are all the different scenarios if you get a Trump victory. And I think what's interesting is that Trump as a candidate is one who probably has a very clear ideology, but he has a very distinct lack of clarity about policy. So you can tell there we have 3 scenarios for Trump versus 1 for Harris, and that ranges from the same as he did last time, which is basically a trade war coming back. We could also see a much more market-friendly policy, which would be lower taxation and deregulation, which would probably be positive for equities. Or we could see a combination of those two, a kind of full-fat Trump, as they call it, which would be probably very pro-America, but would be much more difficult to kind of disentangle for global equities. The one thing that everyone is focused on is what's going to happen with trade policy, and you can see bottom right chart there just kind of gives you a weighted sense of where tariffs sit on imports to the US, and you can see that step up in the first Trump administration going from a low mid-single digit percentage weighted tariff up towards 20%, and the Biden administration has broadly kept that flat since then. If you had a more aggressive set of Trump policies in line with what he has proposed in campaign speeches so far, then you would effectively see that weighted tariff go up towards 40%, largely driven by a proposed 60% tariff on Chinese imports. And that's the main policy thing that we're focused on for investment decisions, because that has a meaningful impact on Chinese exports and on how the global supply chain arranges itself to supply the US as the main consumer of global goods. Moving on from politics, we can have a look at economic change. And when we think about economic change in 2024, it's really been a continuation of what we've seen over the last 2 years, which is that the things that matter have been interest rates. And this year we have seen moderation in inflation so far, and we've got to the point where we've started to see interest rates. So the outlook as it stands at the moment is for pretty consistent, not stellar, but good global growth across all the markets we look at. See our economists' output in the table there, and generally we are looking at roughly trend growth in GDP combined with inflation coming back towards or even below the kind of 2% level we would expect. And that allows central banks to bring policy rates back over the next year. Debate how quickly that will happen, and it will be very data dependent, but we're getting to a scenario where the level of volatility in the global economy is much less than it has been in the period post-COVID over the last couple of years, when we've obviously seen a rapid rise in interest rates and then the start of a pullback. That is quite a nice scenario. It's a good scenario for investment in that it gives us some growth, but it also gives us a high level of stability. That's generally what markets like. And for us as fund managers, it's a great setup because we won't be getting pushed around by the macro in the same way we have for the last few years, and we can really start to see company fundamentals and valuation reimpose itself on investment returns. The one thing I would say perhaps is that this is quite consensual. Everyone has this fairly Goldilocks or soft landing view on what the economy would do. But if you do look at a number of indicators of recessions that have been used in the past, I put the chart of the New York Fed rule there, which is the kind of yield curve inversion measure that people often refer to. You've never had that triggered without a recession in the past, and it is still being triggered. You still have this economic condition that would historically point to recessions. So you can't be totally relaxed, and we should always keep that slightly defensive mindset when we invest. We want things that can survive a recession and can continue to generate income for the portfolio through a recession, because if we're investing for 3-5 years, there's every chance the economic cycle is not as beneficial at some point in that period as it is today. The end of rates volatility, as I put it here, is really important for investment from our point of view, because we've had this period where interest rates as they stand are not actually that unusual compared to history. 5% is probably a pretty typical level. What's unusual is that we've come from a period of abnormally low rates and gone up very quickly. So that shift from 0% up to 5% stresses things in the financial system. It changes companies' capital allocation, it changes investors' capital allocation, and it changes the way a lot of people value equities and think about what the right price is. So that's created quite a difficult investment scenario. But the outlook now, as we show in the chart in the top right there, is that we've got this pretty consistent global process of interest rates normalizing and coming back into that kind of 3 to 5% range that we would consider normal. And that should be a good place to be. If we get back towards, let's say, 3.5%, which is where I think probably the UK should be, it's a good setup for investment at a reasonable cost, but for the system to behave in a way that doesn't create irrational valuations. When you have 0% interest rates, it creates the propensity for people to take on too much risk and to allocate capital to low return assets. It's actually not what we want from our companies over the long term. So we're getting back to what we'd consider a favorable interest rate environment, which it's a good place to be. The path of that interest rate environment will be important. And anyone who watches markets through this year will see kind of how volatile the market can be just based on Fed rate decisions through the year. You can go from saying everything's going to be disastrous, interest rates are not coming down, to the Fed cutting by 50 basis points last time around, and suddenly there's this exuberance that's going to stimulate the economy and everything's going to be okay. I think we would kind of take the view that interest rates will come down modestly. The rate matters less, I think, than where they end up around the end of next year. And that rate of interest rates cuts will be very data dependent. We will see, I don't think I've lived through a period where things like monthly job reports and monthly inflation figures in the US have been quite so closely watched because of that read through to interest rate decisions. So far, it looks like inflation's controlled and the US economy is still growing strongly, but we should all kind of keep in mind that if we look back at situations like the 1970s, you had really a return of inflation when everyone thought it was finished. And we're strangely tracking that 1970s map very closely. But I think there's good reasons why we'll be back in a lower inflation world soon. The next big economic thing for us really as UK investors is the UK budget, which happens at the end of this month. And it's been quite well trailed as to what Rachel Reeves as the Chancellor is likely to do. The one important thing we think is likely is that she will, in some format, reclassify the way UK public debt is measured. That gives some wiggle room in spending. So although everyone thinks the UK budget is in a bad place, it's not actually worse than other developed markets, and there are some tools she has to make things a bit easier. That being said, I think we will still see tax rises coming. and the nature of those tax rises will be quite difficult to predict. The Labour government has said the big taxes in terms of corporation tax, income tax, VAT are ring-fenced, so that leaves some wiggle room on things like CGT and inheritance tax. But I think, as we've already seen, as the government has kind of slightly road tested these by leaking potential changes, any tax changes are quite unpopular, and these smaller taxes actually raise very little money. So I think they will be quite careful about what they do, and the focus will be much more on that pro-growth agenda that was campaigned on during the election. So I think after the budget was kind of flagged as being a difficult one, probably the outcome will be slightly more benign for the UK. That takes us on to market change and what's happening in markets. And now we've gone through that period of zero interest rates. We've had the interest rate bump, and now it's starting to normalize. My sense is that the market is kind of re-engaging with fundamentals again. And we've had this extended period over, let's say, 15 years post the GFC, where 0% interest rates have created a very unusual investment. And one good way to show that, I think, is just showing value versus growth performance. The top right chart there shows you trailing performance for value versus growth. When it's showing a blue bar, then over that trailing period, value has outperformed growth. And historically, that's been the way markets have performed. You tend to do slightly better if you focus on buying things cheaply than if you focus on betting on growth in the future. The low interest rate world of the last 10 to 15 years created this anomalous environment where growth was particularly strong. And there's no reason why growth won't continue to perform well in the future. But we've got to remember that that was highly unusual. In the portfolio, we take a much more style agnostic approach. But for most fundamental investors who do care about the valuation of companies, then the last 15 years have been pretty tough, because looking at valuation hasn't really determined your investment outcomes. As interest rates normalize, then actually you start to worry more about valuation naturally, and I think that will change what works a little bit. We've also seen that really strong outperformance of tech over the last couple of years, which has given another leg to the growth performance, and it's also created a very high degree of market concentration. So the bottom chart there just shows you how concentrated markets are in terms of the weight of the largest 10 stocks in America being the orange line, way above what we saw in the kind of dot-com bubble. And again, as we look forwards, there's that, I think, potential for a bit of that to unwind, for market dispersion to increase, and for slightly more value-weighted stocks to come back and perform well. That kind of informs how we think about the UK at the moment. And if we look at the UK market is definitely cheap. We now have a degree of political stability, a reasonable economic outlook. There's actually no reason for the valuation to be quite so disconnected in the UK. The chart up at the right there just shows you, I think, a nice comparison of UK sectors compared to US sectors. And that's the 12-month forward price to earnings multiple of all the UK sectors, what discount that's on compared to the US. The current in dark blue, the long-term average in the light blue. And people say the UK is cheap because it doesn't have as much growth, doesn't have enough tech. That is true. But if you go across every sector, the current discount of the UK versus the US is very stretched. So it is not just a sectoral bias. There is a real value opportunity here for UK companies. We see that particularly in UK mid-caps at the moment. And the bottom left chart just shows you the FTSE 250 compared to the FTSE 100. So mid-cap versus large cap. And it has underperformed for quite a while. Generally, that performance correlates with what we expect from bond yields. So in a lower interest rate world, people like the growth of mid caps and they're willing to take on a bit more risk. Mid caps generally outperform large caps. So our expectation would be that history repeats this time around. As we see UK interest rates come down and bond yields begin to slowly fall, we'd expect to see that mid cap valuation correct upwards. The bottom right chart is kind of an important one, because what it shows you is the disaggregated performance over the last couple of years of different markets. The orange dot there just shows you the overall contribution in terms of returns. And if you break it down, that's made up of how much earnings have grown, how much the multiple has expanded, and how much you've earned from dividends. And if you look at the UK FTSE 250 on the far right of that chart, what's really interesting is that it has performed really poorly, but it's performed poorly because it's derated. So the dark blue bar is a big negative. The actual earnings growth that the 250 has generated, so how well the companies are performing fundamentally, is the light blue bar, and that's a really strong positive. It's as a stronger positive almost as the US market. So the UK mid-cap space is fundamentally performing very well, but that hasn't been reflected in valuations, and in fact the reverse over the last couple of years. So that's a great setup to buy companies that are performing well at good valuations. The dividend outlook is obviously important for us, and I think after a period of really strong capital growth in markets and growth outperformance, income has perhaps been a slightly less important component of returns for a lot of investors. But if we look back over the long term, income has made up around half of total market returns, and I think it's definitely going to become more important. In part, that is because market levels on a global basis actually look quite high, and market levels are a great predictor of forward returns. It's no surprise. If you buy something cheaply, then your forward returns will be higher. As shown in the bottom left chart at the bottom there, it uses the US market because the data is longer. But what you can see is that when the normalized price to earnings multiple on the x-axis is low, then your forward returns on the y-axis are high. That makes perfect sense. Where we sit at the moment, the average forward returns over 10 years actually is predicted to be 0% capital return. So that's not a great setup. I'm not saying that will happen, but if that was a scenario that played out, then income as a component of your returns, if you can generate 5% per annum income return, it's going to be much, much more important to your total return. And that definitely favors the UK market. The chart on the bottom right there just shows you dividend yield and buyback yield across the major developed markets. And UK is the one on the far left-hand side there. It has the highest dividend yield in orange. I think that's well understood. It also has the highest buyback yield of all the developed markets as well, which is a recent change. And that's not just a comment on UK companies thinking their shares are cheap. It also tells you they've got capital to distribute, and balance sheets are in a pretty good shape. So how are we in Shires reacting to all this change? When we think about portfolio construction, the main outcome is income, and we're trying to generate that. Shareholders, I think this is a great chart to kind of show you the income proposition in a very simple way, which is the yield Shires has delivered over the long term. It's been pretty consistent around that 6% level, and that's obviously a meaningful premium to the all-share index. It's also a premium to UK gilts, investment grade credit, or global equities. What we've seen in recent years, and I think why the equity income space has been a little bit challenged, is that gap between the yield we earn and deliver for clients and the yield you get on bonds particularly has narrowed as interest rates come back up. So you see, cash or bonds deliver a much more comparable yield. What we would expect to see is that as interest rates come down, yield you get on cash, for example, will go down as well. But what we would aim to deliver is that very consistent high yield from the portfolio. And as that gap increases, I think the appeal of equity income, and particularly equity income from a closed-end vehicle like Shires, becomes much more appealing for end investors. When we're looking to invest, we're trying to be very size agnostic in what we do. The charts here just show you, I think, the spread of positions by size, by market cap on the x-axis and by dividend yield on the y-axis. The point is trying to make is really we hold positions all the way across the market cap spectrum, from companies in the tens of millions up to in the hundreds of billions even. And at the moment, where we see value is shown, I think, quite clearly in the chart at the bottom. So Shires in the blue bars versus the benchmark in the black bars. We're roughly underweight large cap. We're slightly closer in large value because we see good sources of income there. But where we're meaningfully overweight is mid cap, growth and small value and small growth. So it's lower end of the market where we see really attractive growth and income at the same time. I'll very quickly talk through a couple of things that we have been doing in the trust recently. Please feel free to ask me about any specific. But I kind of called out two areas we've bought recently. UK domestic opportunities is one. So at two ends of the market cap spectrum here, Lloyds as a UK bank. We see the UK banks positioned extremely attractively at the moment because they've got a really good hedged position, which means we'll see genuine earnings growth over the next couple of years, even as interest rates come down. They're very capital generative, and obviously they pay a highly attractive income. Then the smaller end, Hollywood Bowl is a great example of a UK mid-cap company, which is totally market independent, but it's a good operator that's delivered consistent earnings growth, which is what you can see in the dashed line there, and a high yield, and just a kind of underappreciated mid-cap name that I think fits our approach really well. We're also looking for things that will do well in a lower rate world as interest rates peak and start down. Examples would be utilities. So Enel is an example in our portfolio, which has done really well, still delivers a 7% yield, and utilities tend to correlate negatively with interest. Sure, another great example of that, it's a UK healthcare property company. Again, it's as close to a bond proxy as I think you can get in the market. And as it sits, it delivers 8% yield for us. When we see interest rates start to come down further, I think the capital value will reflect that as well. So a very defensive position, which will deliver absolute returns going forward. So that's the end of the presentation. Just to sum up, 2024 has been a year of change politically and particularly markets. And I think we're approaching a period of perhaps a bit more stability and a period where fundamental investing can actually come back into favor a little bit. That change leaves the UK increasingly well positioned with a much more stable political and economic outlook than a lot of other markets, and with an equity market which is quite obviously undervalued and with better potential than a lot of others. So that sets us up, I think, for a period where UK equities can perform well, but equity income also can start to perform well and really deliver that kind of income and growth that I think is really important to a lot of shareholders. Thank you. Over to you, Joe, for Q&A.
Thank you very much, Ian. Yes, that was a really, really good update, I think, on the economic outlook for the UK at the moment. And it does paint a very interesting picture, to be fair, so that's good. We have had a couple of questions come through from the audience, and I think before we dive into the stock-specific or portfolio-specific questions, there's just a couple on a few varying ones on rates, one relating to trust costs and direction of rates moving forward. So let's perhaps start with the direction of rates. I guess it's the expectation really, and a bit of a consensus that in time, short to medium term, rates are expected to fall at varying levels and varying speeds. It's hard to kind of pinpoint, but in a hypothetical scenario, let's say that expectation or consensus is wrong and rates remain stubbornly high or even go higher again. How do you think the portfolio, Shires portfolio, is positioned should that happen?
Yeah, it's a great question. I guess we've kind of tested it in the last few years with rates going up, so we've got a pretty good idea of how it performed. And we try and think quite holistically about sensitivity to rates and balance out that risk. What we've got in Shires, the preference shares, they deliver a great amount of stable income, but in an environment where rates go up, naturally they will perform like a bond and the capital value will go down. So that will have a mild drag on performance relative to an equity-only benchmark. And that's what we saw over that period where rates went up quickly. To offset that, the equity portfolio is slightly weighted to value, so that helps relative to growth in a period of rising rates. And we've also got some meaningful positions in there in names that are positively correlated to rates. So the most obvious ones would be the large banks. Something like HSBC is quite highly correlated to positive rates. UK domestic banks are the same as well. And we'd also expect that higher rates would only occur in an environment where we also have high inflation. So a good amount of commodity exposure there acts as a really good hedge against inflation as well. So we think about it holistically and we try and balance it out so we're not too sensitive on that macro environment.
Fantastic. And kind of keeping on the line of costs, when you look at the kind of ongoing charges figure, the Shires, it is above the average of the peer group. One of the questions that's come through kind of leans on that and says something along the lines of, with a charge like that, it could potentially eat into the dividend yield, and with rates being high in certain environments that we've seen, savings accounts are quite attractive. Have you got any kind of thoughts or comments on that, particularly given performance of the sector in general over the last few years?
Yeah, I mean, the treatment of costs is obviously quite a live discussion, I think, for investment trusts at the moment, and it depends how you show it, but Shires often screens as being high cost because of the cost of leverage, which funds the preference shares. In our view, that's a slightly unfair way to characterize the costs, because you are obviously paying interest on your debt to fund the preference shares, but you are earning the income back, and because you're earning a premium of income, you are earning money on that leverage. So the underlying costs are not outsized, to be honest. Does the cost eat into the, like the yield you get as an end shareholder is as published, right? So I think the income generation for end shareholders is highly attractive. We are confident of delivering that income generation, including the costs that we have to deal with. So we think very carefully about that. And a rise in interest rates would put some pressure on the cost of leverage, but we have the cost of debt fixed for another couple of years, fortunately. And I think by the time we get out there, we'll probably be looking at lower interest rates. So I feel reasonably comfortable with that.
Absolutely. And I guess, I think we've spoken about this before, Ian, but you can almost, in a way, offset part of that through the higher yielding preference shares, like you said, the kind of 7.5% yield on those. So that makes absolute sense. Thank you for that. I think it would be really good just to lean a little bit more on the political part. I know you covered it in the beginning of the presentation, but perhaps making it more portfolio or stock specific would be really useful for those listening in today. Kind of perhaps drawing on those stocks that you think are worth highlighting in terms of the impact from the UK budget, whether that's potential beneficiaries or whether it's areas that, given relatively unknown certainties can pop up, it might be a bit of a worry for you in time.
Yeah, so in terms of the beneficiaries, I think the clearest positive impact we would expect from the budget is the use of government budget to drive growth through the economy.
Yeah.
And the easiest way for any government to do that is through increased investment in construction and infrastructure. So the way we've tried to play that in Shires is having quite a big overweight position in some of the UK construction names. And these have been names we've liked for a couple of years now. So Morgan Sindall, Balfour Beatty, Kier Group, they are top tier contractors in the UK, and they dominate the market of building government projects, basically. So that can mean grid upgrades on the energy network. It is building schools, building prisons, building hospitals, all this kind of essential construction work which needs to happen and which we think is going to be funded by the government and also by utility companies, for example, who have a great need to invest in infrastructure as we go through an energy transition. It's a sector which has been unloved in the recent past, right? Because it historically took too much risk, and you'd see companies like Carillion and Interserve, for example, fall over because they didn't manage that risk correctly. But it's a sector that's gone through a huge amount of industry repair in the last 5 to 10 years. Contract structures have changed. The risk sits with the government rather than with the contractor. Margins are not super normal, but they're very stable, which gives you a high degree of visibility. And we'd expect to see the backlogs and workload for those companies continue to grow through a pro-growth, pro-investment Labour government. So a sector we think is super well set for the next few years, and one we've got a decent overweight in the the fund. In terms of risks, I think it's hard to see where the risks are. I mean, the most obvious one for me, Labour government, that was well flagged, was probably impact on UK domestic energy, particularly North Sea oil and gas. And that's largely played out in prices. You've almost seen that come through because of the windfall tax that was put in place by the Conservative government. And it's become a very difficult place for companies to invest and to grow production and grow capital value over time. So it's one we don't really have in this fund. That being said, there are hugely attractive valuation opportunities in that space if we look at it now, even after you take into account the tax take. And then other risks, I think it's difficult. I think that the risk is you see tax impact on wealth and on property valuations over time, but the impact of that, I think, on individual stocks in the market day one actually would be fairly limited.
No, that's really, really good. Thank you, Ian. And kind of moving a little bit more into the opportunity set then, I think it would be great if we could talk a bit more to the mid and small cap allocation. And in this case, I think it's best to almost break it down into two parts. So the first part being up until about December 2023, a large portion of Shires portfolio's exposure in SMIDs came through Aberdeen smaller companies income. But obviously the successful combination of that trust has changed that slightly. So it'd be firstly good to hear your views on how that transition's gone and maybe talking to a few names that have carried over. And then the kind of second part on that is why you think small and mid caps are offering such value right now and playing that kind of key role in differentiating trusts, particularly in a sector like the UK equity income space.
Yeah. So firstly, starting with the trust combination, I think it's gone very well for us. It's done what we would hope it would do, I think, in that it's scaled up the trusts into over 100 million, which I think is an important milestone for us, and helped lower costs for the end client, which is important. And then it's removed, I think, from an investment management point of view, a slightly too high weighting on one individual position where we couldn't control the portfolio and you were somewhat at the mercy of the discount or premium that trust traded. Instead, we can take direct exposure in small and mid cap equities. We can be slightly more concentrated in that exposure. You know, if you think you had 10% of the fund in one trust, which then invested in 50 to 60 equity positions, actually the bet you were taking on each one of those individual companies was quite small. Now we can take that down and maybe that 10% is in 4 or 5 individual equities. So we can hopefully pick the ones that best suit our mandate, are best able to deliver dividends and income growth over time. And we can be a little bit more selective about which companies we think fit. We didn't take that many names over. I think we took Bytes, Hollywood Bowl, Hunting, and there was a lot of overlap between funds as well. I think the nice thing is we continue to work really closely with the team that runs the smaller companies' portfolios. That's fantastic because they're really good UK smaller companies, investors who have a really good, consistent process. And that's great for idea generation for us. It gives us the ability to meet a lot of smaller companies that we might not meet otherwise. And it gives us, you know, these new ideas where we can select the ones with good income to go in the portfolio. An example of one we put in recently is a company called ME Group, who operate photo booths and laundromats in Europe and Asia. Sounds like a very niche business, and it's probably one that most large cap managers won't come across. But that partnership with the small companies team gets it on our radar. We meet them, we dig into the business, we get comfortable about the outlook for growth from that business and the income and cash characteristics of it. Great fit for the portfolio, and we can take a position in it. So I think it's working really well. And so second part, why is small and mid cap really attractive right now and a good differentiator? I think the valuation stands out, and I think if you do look back over the long term, very simplistically, UK mid caps outperform large caps pretty well, and I think that's simply a reflection of the fact that smaller companies can continue to grow more easily than large ones can. It's a more diverse index, and it gives you access to some companies which have really good quality characteristics in terms of stable compound growth, often in terms of having really good management teams that are founders that have been there for a long time. And you can take good active positions in these companies and let them grow for a period of time and deliver the kind of income growth that we're looking for. But I think, above all else, valuation at the moment is super attractive for that area of the market.
Absolutely, and I think valuation is just a hot topic anyway with the UK. It all seems to crop up when we're discussing it.
And Joe, I don't know if that maybe reflects a bit of a pullback of liquidity in UK markets over recent years, and naturally, as liquidity pulls back and perhaps focus from global investors on the UK lessens slightly, the attention span focuses in on the large caps, and you get left with a bit more blank space to differentiate yourself as a fund manager in the mid caps. As we can see from the kind of the fund manager survey that I highlighted earlier, attention's coming back to the UK, so maybe that trickles down and we start to see the smaller mid caps get a bit more attention going forwards as well, which would be good.
And I guess, again, keeping on that valuation front, you, as a portfolio manager of Shires, have that flexibility to also invest overseas if you deem fit, and that allowance has increased to around 20%, and it gives you the option to fill in gaps in the UK with other strong quality businesses, whether that be in Europe or other non-UK markets. And looking at, depending on what day you look at it, Shires is about 8 to 9%, I think, exposed to the overseas non-UK names. So it'd be really good, Ian, to get your thoughts on how you think about allocating to those companies, particularly given valuations are also looking attractive in the SMID and even large cap space in many non-UK markets.
Yeah, so like you said, we recently took the limit on overseas holdings up from 10% to 20%. And we had to convince people that we weren't going to go from 10% to 20% on day one, just because the limit had changed, and fortunately we've stayed around just below 10%. So we've proven, I think, that the limit doesn't drive the investment policy as such. Why are we where we are? I think when we look at the overseas companies, what we're looking for is something that differentiates us, that helps diversify the portfolio, and that adds a company that maybe we can't find like for like in the UK market, because generally we'll be naturally disposed to buy UK equivalents, particularly given that valuations in the UK are low, and given that we probably know the companies better, we probably meet the management teams more regularly, we probably have better insights, I think, as fundamental managers. But the fact is, you do find great companies in Europe and the US, which we can't replicate in the UK. The most recent addition was ASML, which is obviously high tech, high growth, not high income, but something that you can't find in the UK. And we just added it after valuation had pulled back recently. It's something that can do, in our analysts' view, 25 to 30% growth each year over the next few years. And it's their top pick of all the global technology stocks. So we have the opportunity to own that. It's a great differentiator and a diversifier for the fund. So we want to be able to hold those stocks. That weighting to the overseas will vary over time, but it will depend much more on individual stock opportunities and things we think are interesting, rather than trying to target the weighting as an outcome, I would say.
No, that again makes sense. I think it's good to have the flexibility, but also the kind of focus on not just using it for the sake of using it, keeping it there as a differentiating tool, which I think, yeah, at the minute you guys are doing. On the performance front for Shires, the last few years, I think we can all attest to being incredibly volatile and turbulent, and a lot of pressure has been put on the sector in general to perform with kind of factors coming sharply in and out of favour. and Shires obviously being no exception with your kind of quality focus that you guys instill from the bottom up. So it'd be really good to kind of get your views on performance, but equally over the last 12 months, things have picked up. And it would be good to hear your thoughts on the drivers behind that as well.
I mean, when we think about performance, I think we're always going to get compared to a equity benchmark. We try and ignore that as much as we can, partly because I think it's not massively helpful to think about your benchmark, mainly because it's a differentiated product. We've got a big weighting to fixed income, which won't perform like equities. And the main outcome that we're shooting for is not capital growth, it's income generation and income payment to shareholders. So we try and ignore the benchmark. I think performance, though, has actually, it's been pretty good. I think we've delivered the income, we've grown income over that time, which is good. And we've largely kept pace with markets, which for a trust which has quite a defensive position is a good outcome. Because if we are providing high income and growing income to end shareholders and also delivering capital growth in line with equity markets, I think that's a fantastic outcome for shareholders. Performance on a relative basis, if you look back at the time when interest rates went up sharply, then obviously that was reflected in valuation for fixed income, and you would see overall performance lag a pure equity benchmark. At the same time, equity markets have been driven by more growthy parts of the market, which are not traditional sources of income for us. So I think that's been another slight headwind in relative performance. But I think there's that statistic at the moment, Joe, that it's a tough market for active managers. Only 30% of active managers have outperformed the benchmark. And when we look at our equity portfolio, we're in that 30% over 1, 3, and 5 years. So we're doing the job, but the main outcome is income, delivering that high level of income and making it resilient and growing over time. So, we've got to try and focus on that more than as much as actually performance, for sure.
Absolutely. And I guess veering off from that slightly then, have you got thoughts as to perhaps why the trust's discount is at its current level? I think, again, depending on the day you look at, kind of around 10% or so, with that resiliency of income and the ability to kind of yield that level consistently, performance, keeping pace. What are your thoughts on the trust discount?
Yeah, I mean, the discount it's a frustration for us, as I'm sure it's a frustration for existing shareholders. There's not that much we can do to control it, and it's very much in line with what we're seeing across the closed-end fund space in the UK. The discounts are wide. I think that reflects a bit of a lack of liquidity in the space. I think it reflects the fact that it's quite easy for a lot of allocators over the last few years to have a large allocation to cash earning 4 to 5%, and then an allocation to effectively tech or the S&P 500 to deliver a growth element. That's worked absolutely fine. Of course, as cash yields go down, that return goes down. And if we get market dispersion away from leadership in tech in the S&P 500, then that return can also go down. So a lot of allocators are taking quite a big bet on those things. I think we do something different and we offer a different approach, but there probably hasn't been quite as strong a need for that in a lot of asset allocators' views over the last couple of years. And that's probably weighed on discounts to some extent. What could make discounts close? I think from an equity income perspective, interest rates matter. If you are only earning 2 to 3% on your cash savings or cash ISA, I think most intelligent investors would see the appeal of a 6% yield from a closed-end vehicle with revenue reserves and with capital growth, and that would start to look more appealing as cash yields go down. So I think that will definitely help for sure. But for a new investor, I would say the discount is a great thing. Right? People say there's no such thing as a free lunch, but from an income perspective, this is a real free lunch, right? Because if it was trading at par, the yield you would get as an investor would be 10% lower than what you can buy today. So the end investor is getting a 10% higher yield, but as managers, we don't have to go and generate that. We don't have to take more risk to generate that yield. So it's a genuine income-free lunch for the end shareholder if you buy at a discount. And that's a pretty good opportunity. So much as I hate high discount, it's a pretty good opportunity for any new buyers.
Absolutely, and I think that free lunch phrase appeals to many. So nicely done there, Ian. I think. Just very, very conscious of time. I'll chuck one more question your way. It's a bit more broad, touching on your thoughts on the IPO market and the kind of potential, signals of improvement we've seen of late, and just general corporate activity, really. Ian, if you've got any thoughts on that.
Yeah, I think it's an interesting one, actually. I mean, the IPO market has been moribund for a couple of years, right? And particularly so in the UK. I think at least we're starting to see political and regulatory focus on how to stimulate that again. That's good, and you're starting to see early signs of UK IPOs coming back. And we need that to have a healthy, vibrant capital market in the UK, right? And at least if there's recognition that that's an important goal, then we'll see things happen. There are some things that are politically difficult, I think, particularly for a Labour government, like saying CEOs of companies can be paid in line with US peers. But if we do those things, I think we can get the UK market back in shape and generate IPOs. Capital markets activity and M&A more generally, the UK there's been a lot of acquisitions which reflects low UK corporate valuations. And I think we continue to see that being pretty strong. If we look at global corporates, cash balances are high, and overall M&A activity for corporates has actually pulled a long way back from the peaks. So there's this big kind of, I think, war chest most companies have to go and do some M&A. We're seeing it all the time. We saw Rio Tinto as one of the big UK miners doing a big deal today. And we're quite a way through an economic cycle. And usually you get to this point, companies, they want to grow, they want to deploy capital, they will go and do M&A, and we'll see that happen. And I think we'll see good returns for UK investors, particularly in the mid-cap, the companies getting taken out at premiums.
Yeah, no, and I think it's a really fascinating time in that space, actually, particularly as people are seeing value on offer, and it's actually coming through in that space, which hasn't happened in a while. So yeah, very interesting time on that front. I think, Ian, that's pretty much all we've got time for. We've covered pretty much every question there as well. So thanks again for those who've submitted the Q&As. I think it's been a really comprehensive update, and I thoroughly enjoyed listening to you going through that presentation. But it looks like we have come to the end of our webinar. So for those listeners that want any further information on Shires, Ian and the team published some really good pieces on the website, whether it's deeper insight into the portfolio or insights into the outlook or general market movements. So go take a look there if of interest. We at Kepler have also published a research note on Shires in June of this year, so give that a read as well if of interest. With that, Ian, just a big thank you to you first for joining us today. It's just been great to have you on.
Great. Thank you so much, Joe, and thank you everyone for taking the time to listen.
Thank you, Ian. And yes, again, extended thanks to those who've dialed in this afternoon. And hopefully we'll see some of you make it to our next webinar tomorrow. Take care now. Thanks all.